Hey, Tom here. Welcome to Patterns and Profits. This is our weekly live stream where we cut through the noise, separating headlines and memes from real market patterns you can actually trade. Each week, I'm going to break it down into three simple parts. Spotting opportunities, where we look at what's moving in the market and where real opportunities may be hiding. Creating alternative risk trades, where I walk you through different ways to structure trades, manage risk, and stay flexible no matter where the market's going. And as a bonus, I'm adding Money Calendar Monday, where I look to identify repeatable patterns that I'll be trading based on timing, probability, and structure. Finally, if you want to access everything we have to offer, articles, education, tools, and more, then become a member at patternsandprofits.com. It's absolutely free. All right, enough said. Let's get back to the live stream. Hey, everybody. Welcome to Patterns and Profits. I am your host, Tom Gentile, America's Pattern Trader. How we doing on this Monday, March 9th, 2026? How are we doing out there, guys? Glad to have you as part of the program. If you're new, we do this every Monday. And today, I definitely have a lot that I want to cover with you here in our short amount of time together. I want to talk about, I actually went to the movies and I saw Peaky Blinders last night. For those of you who don't know what that is, I'll let you know. That's why I've got the cap on today. I want to talk about that, and I want to talk about the Roaring Twenties, and I want to do a little bit of a variation between the two. And of course, I want to also get in, and I want to talk about the March money calendar. So we're going to talk seasonality. We're going to get really wide on seasonality. Then we're going to get really narrow focused on seasonality. And then finally, look at what happened with the price of oil. It was up. Did you guys see the price of oil this morning? Last night, USO was up 22%. 22%. I mean, I look at that and those of you that have been hanging out with me here for the better part of, even if you've been around for the last couple of months, my posture on oil and energy. We were jumping into oil and energy before any of this was happening. And, we're hitting numbers. We're hitting levels that, I didn't see this being hit till summertime. And already the goals, what I was looking for, was hit today. And so I want to revisit oil. I want to revisit energy. And I want to talk about if we were to take a trade today in the option market, calls, spreads, butterflies. All right. I'm going to weigh in on all of those, going to show you how to create them. And we're going to look at USO, and we're going to look at cost. We're going to look at risk. We're going to look at reward across all of that. So a lot that I want to cover with you guys here as we head into yet another new week that is happening here on Patterns and Profits. So with that being said, let's go ahead and let's get started, shall we? Glad to have you guys all here. So this weekend, my wife and I went to the movies to see this new Peaky Blinders movie. And, we were long avid followers of Peaky Blinders on Netflix. This is a saga, if you don't know, about a group of gangsters that were headquartered in Birmingham, England. So Birmingham is about an hour or so north of London by my watch. I've been to Birmingham, but it's been long ago. This whole cast, this whole set was taken all the way back into the 1920s. And it actually started prior to the 1920s. It was between World War I and World War II. It included the Roaring Twenties, and it also included the crash of 1929. So I'm sitting here watching this movie, and here I am. I start thinking about the stock market. This is last night, and I'm looking at the time frame. I'm thinking about the time frame then compared to today, and I find it's fascinating how much the Roaring Twenties and the 2020s mirror each other because, what's it that Mark Twain said? He said that history doesn't often repeat, but it often rhymes. And so thinking about that and thinking about those 2 decades, both had a global pandemic when they started. I don't know if you noticed, but back in 1918, it was the Spanish flu. In COVID, it was in 2020/2019. That both of those led up to what's called pent up demand. It had an explosion in the stock markets and it reshaped the stock market. So I want to talk about, first of all, key similarities. So key similarities are what's if you were to transparent layer them on top of each other, what were the key issues then and now? Well, you got technology, all right, and what we call moonshots. And technology moonshots then, in both eras, investors fell in love with technology. And of course, those technologies led to massive bubbles. So in the 1920s, put yourself back in the 1920s if you can for a moment. This was the age of radio, it was the age of cars, and it was the age of electricity. All of this coming together at one time. And so the big stock back then, the big company back then was RCA, which stood for Radio Corporation of America. Imagine this was the NVIDIA of its day. So, sitting here, being able to hear a broadcast wirelessly from one point to another point. Fast forward to today, it's artificial intelligence, it's electric vehicles, and a market that's been driven by a small group of tech giants. So then you got number two, which is the rise of retail. Now, both decades saw retail trading, and that could be for better or for worse, depending on who you were. And in the 20s and the 1920s, that was the first time regular people started buying stocks. There were ticker tapes in barbershops, grocery stores, lounges. I mean, you could track the markets from anywhere. And also a big thing was margin back then. They had 10-to-1 margin in a lot of cases. Now, fast forward to today, you got Robinhood, you got meme stocks, GameStop, AMC. This turned trading into a social media event. And of course, we had, if you remember, stimulus checks, which helped stimulate the rise of retail trading once again. Now, margin is a lot more regulated today than it was back then. But when you add on things like zero-day options, which I am not a fan of, I see a lot of people out there promoting and pushing zero-day options. To me, that's like a lottery ticket. Now, the other thing that's big in margin is this highly leveraged alt crypto trading. Right, that's created kind of a similar fever that was had back in the 1920s. And then number three, you've got rapid recovery and easy money. Now, both decades saw a period of government intervention, but they also saw a period of low interest rates. So in the 20s, the Fed kept rates low for much of the decade, and that fueled that credit boom, and it allowed the economy to roar after World War I, after the recession of World War I. In the 20s, well, we all know what happened. COVID created stimulus packages and near zero interest rates. Remember those famous words that were uttered? I'm not even thinking about raising rates. All right, that's what Chairman Powell said. That sent asset prices, stocks, housing, crypto to record highs. So take a look at this. This is a key comparison table that I put together on this information. So, you've got here, the first column says feature. The second column, as I blow it up, shows you what happened in the 20s and the 1920s and the 2020s. So you've got, the hype was the radio back in the 20s, artificial intelligence today, the trading hub, ticker tapes, social clubs, speakeasies. Now it's Reddit, TikTok, Robinhood, the speculative asset. Back then was Florida real estate, of all things. And of course, today it's cryptocurrency, NFTs, and zero-dated options. And the preceding crisis, if you remember, that caused all of this. Well, back then it was World War I and the Spanish flu. And of course, not even 6 years ago, it was COVID-19, the pandemic that ensued from COVID-19. So we all know what happened after the 1920s, and that was the stock market crash. Okay, the great crash of 2029. But again, now we've got modern markets, we've got guardrails, we've got circuit breakers, we've got things to slow down a huge crash like what happened back then. But the human emotions, greed and fear, they're literally identical between then and now. So now we got to think about interest rates in the Fed. So to understand, whether we're heading to a 1929 style landing, we got to look at the Federal Reserve. And it was a very different situation a century ago. So if you look at then versus now, then we had the gold standard. You got to look at gold versus fiat. So in the 1920s, gold standard. Fed was required to back its currency with gold. So that meant they couldn't just print money, and especially if they were trying to save a failing market. And so physical gold had to back up any money. When the crash happened, well, the government was pretty much handcuffed. Now, fast forward to today, we've got the fiat system, which means we can create liquidity out of thin air. And in 2020, they injected trillions of dollars in the system within weeks. Now, that prevented a total collapse, but it created a different problem. And we all know what that problem was: inflation. So if you look at, for instance, the rate policy, which is, we call it then versus now, back then, the Fed actually raised rates. So we know this. We know the Fed raised rates in 1929 after the market started to wobble because they were protecting gold, and they were also worried about speculation. So that was what ended up happening. And what they thought was going to occur and what did was something different because they actually choked the economy this way. Now we've learned from that mistake. And the 2020s, the Fed's playbook is basically the opposite. They're saying lower rates for longer, and it creates more of a softer landing and maybe more of a recovery approach. So the big question we have on our minds, and you should have on your minds right now, is this one: are we headed for a 1929 style bubble? Now, most people out there, if you talk to them, most economists think it's unlikely. And more likely, we're going to see something called stagflation or a stagflationary grind. All right. But let's look at what often rhymed, okay, if not repeated. So these are what we call the danger tables. And this is 1929 versus 2026 today. And so when you take a look at the danger tables that are out there, you've got the 29 bubble, that was electricity, radio, and then we've got our frothy moment right now, which is AI, and the danger level is considered high when you look at the fundamentals behind it. And the reason why is because you think about it, we're gearing up for all this AI moment, and perhaps the stocks, the companies behind those, aren't ready to give us the profits yet because they got to invest a lot of money into this moment. Retail behavior is similar today. You got margin buying at barbershops back then. You got 0-day options on apps today. Company health. Back then, RCA didn't even have any money. All right. They weren't making money. They were just a thing, and everyone was all hyped up on what we called the transformative profits. So there's that. Right now, all the AI leaders are cash rich, but that may change very quickly as they have to put together the money to pay for the infrastructures. And of course, valuations, back then RCA was just absolutely insane. It was just, to give you an idea, the stock went from $11 a share back then to $114 in a year. They never even paid a dividend. And so the reality is that you look at the hyperscalers, NVIDIA and the following, they all had the similar path. And so that's the thing when you look at these danger tables that are out there. So there are some very high danger levels, and then there are some valuations which are really considered moderate. So as we move forward and you take a look at everything, we talk about before where we looked at the 10-year cycle. And while the outlook going forward, we're still, less than halfway through this decade. And so, even with things like Bitcoin seen as digital gold, you've got altcoins that are considered an area too that you got to worry about. You've got market concentration where, you have a handful of stocks like the Mag 7 or whatever we're calling it this week. Those could be, if one or two of those fall, it could cause the overall market to drop. As they own about roughly 35% of the S&P 500. But, if we were to compare those all together, you still have a half a decade, like I just said before, we see this whole thing play out. So let's narrow our focus. I'm looking at the money calendar right now for this week. And this week, and the news that's going on, you got to be looking at this going, well, what do we do now? You got a market that's down again this morning. You got oil that's just gone off the charts again this morning. And with the conflict that's going on in Iran, and it seems to be escalating, not even by the day, but by the hour, there is a growing likelihood that this may last longer than a lot of people, even me, expected. Mark has been selling off. Look at last Friday's jobs report. Came in surprising. Non-farm payrolls fell by 92,000. They missed expectations. They thought there were going to be about a $55,000 to $60,000 job gain. Unemployment ticked up too. That's what caused the market sell-off on Friday. And it's worth noting that this is the third time in the last 5 months that the labor market's posted job losses. So this is a bit of a scare, although I think it could turn out to be something that could be longer-term win for the stock market. So, some people are looking at different stocks out there right now, and it's kind of like trying to pick a needle out of a haystack. And as my researcher, Jay Harris, says, instead of picking a needle out of the haystack, why not do something different? Why not just, instead of trying to find a needle, how about trading the entire haystack instead? So as we look at the money calendar and we look at the movements here for March 9th through March 13th, immediately I see bullishness. But keep in mind, what am I looking at right here, folks? I am looking at ETFs. And so if you look at the ETFs across the board, I've got from the mid 70s to the low 80s in terms of the number of ETFs that are bullish versus the number of ETFs that are bearish. And for those of you that need a little bit of schooling on this, what's an ETF? It's just an exchange traded fund. All right. It allows us to access broader markets. So we're not going out there putting money into one single stock. We're putting into a bundle of stocks, a bundle of bonds, or maybe even a bundle of other assets into one particular product. And that's what gives us diversification risk. It means we're going and risking against several stocks, regions, or themes without having to pick an individual stock or an individual security. So we're leaning bullish on the money calendar, but keep in mind this is bullish with a twist. We're looking at ETFs that are tracking the most bullish right now versus bearish. Now, I want to tell you something else. We noticed a similar pattern today that we've been talking about for weeks, and that pattern is safety. So take a look at what you see down here near the bottom. You'll see two different symbols on here. We actually talked about this sector not long ago. And it's not oil, and it's not energy, and it's not utilities. It is gold, in this case, gold miners. So you got two of them that popped up here that look really well. I mean, one's got a 90% accuracy in the last 10 years. The other's got 100% accuracy. And so I'm talking about GDX and GDXJ. These are gold mining ETFs that track regular size or mid-sized to small-size gold mining companies. So instead of owning physical gold, what GDX does is it holds shares of major gold miners, maybe Newmont, Barrick Gold, and Agnico. These are just a few. So what's the difference between GDX and GDXJ? GDXJ is the gold miner juniors, and they invest in smaller mid-sized gold companies, all right? So they're more on the exploratory or early stage production phases. That's the difference between the two. Both of these patterns are bullish over the next 30 days. And so when I look into these, I got to take it a step farther, and I want to see, well, first of all, let's take a look at GDX. 10 for 10. That means in the last 10 years, GDX has held a really nice pattern here, going from 2018 to 2019. In fact, the worst of the years was, guess when? 2020. And it eked out something just a little bit less than 1% during this 30-day time frame. Last year, 25.45%. And as you remember, we've been in a multi-year bull pattern for gold and for gold stocks, especially GDX is going to be in that pattern as well. So, I take a look at that, and I also go in and I take a look at, well, what about the junior miners? Very, very similar. So no reason for me to kind of repeat that. But you've got here 9 out of 10 or 10 out of 10 high historical patterns. When you take a look at GDX, the pattern itself, this is what's going on with GDX here coming into today. So, this one's just been kind of on a tear for years now. But if I were to take the most meaningful pullback, that would have happened at the end of October, right? End of October, beginning of November, when the GDX ETF dropped just below 70. And of course, we ran up into the fourth quarter, at the end of the fourth quarter into the first quarter of 2026. As you can see, this pattern ran up above 110, had a little bit of a pullback, then jumped up again to above 110. And right now we're sitting just above 101 coming into today. So there is the seasonal pattern as we look at GDX and we look at the gold sector as well. So once again, what are we talking about here, folks? We're talking about that in times of crisis, safety stocks will rule the day. And safety stocks they've been oil, they've been energy, they've been utilities. There's even some regional banks in there that have fallen into this area. But I want to also let you know that gold has been on this list as well. All right. War patterns are often followed by safety first and then the stock market later. So what I mean by that is that as you start to see the entire herd jump into safety, and that seems to be the case in the oil market. And, we would expect the same thing to happen with other safety stocks. As you see the herd, as you see the crowd move into these areas, that's when we got to start looking at the overall stock market in that later session. And that's those stocks that we're seeing right now. And even ETFs, SPY, QQQ, DIA, those will be the next patterns that happen in the cycle if those cycles indeed end up happening. And then finally, of course, we want to be ready for the turn, right? If you want to be ready for the turn and you want to be ready for the turn with all of my research, then you see that little QR code that's sitting above me right now, all right? That is for a special price that you could get my stock and ETF research for less than $1 a week, all right? Right now, it's for a limited time. And for those of you that are brand new, want to take advantage of something that gives you all of my seasonal research as America's pattern trader, then that's how you do it with the product we call Stock Cycles Trader. So there you go. Get that while it's hot. And we will get into something else that I think is pretty hot here in just a moment. All right, so I am, looking at this pattern in oil, and I'm just like really just shocked at what happened as we came into this morning. I mean, wow! If you didn't realize it, and I got to bring it up on the screen. This is crazy. So I'm bringing up my Robinhood account right now because that's the one that's going to give me that real time data as we see it. And you'll see what's going on with USO. And so take a look at this. This is really quite interesting. This is United States Oil Fund ETF. And I want to show you, here's where we are right now. We're still up 4.34%, even though you see this drop that happened. But this all started overnight, 1 a.m. All right. We were showing the markets opening 23% higher. 23% higher. Check it out. It's on the screen for you right now. This is absolutely insane when you see what's happened in the oil market. And we have pulled back some. So is this the area where, exhaustion happening in the markets? All right. It's very interesting to see if that is going to be happening here. Let's return to the oil pattern here. Let's talk about the oil pattern for a moment. I don't want to spend too much time on this, but what I do want to spend time on is the fact that it's moved so far, so fast that, are we in a situation where the oil pattern, is it over? Are we going to be in a stagflation for oil for the next few months? Right? How about this? If I were to trade oil right now, what would I do? And that's what I want to talk about here in this particular session. Is I want to talk about comparing different option strategies for cost, risk, and reward. So, getting into those, well, let's take a look at oil. And this is oil coming into the day. And you can see here, this is USO. It looks exhausting. And what I mean by that is get an idea where we first started talking about oil. We first started talking about oil as a 5-month pattern starting in mid-February, running out to mid-July. But USO is below 80. And I was looking for 100. And we crushed right through that here coming into the day. Crushed right through that. And so, where do we go from here? We could stagflate here. We could make a slow grind to the upside as news continues to develop, or we could pull back for a later run back up to the upside. So if I were to trade this today, what are my options? I want to talk about the 3 options that I'm looking at in this market. And then again, what we can look at how we trade each of those options. And I'm going to go ahead and set them up for you here, right here, on the screen. So let's start off with call options. Now, call options is the easiest thing to trade. I mean, they're an option where you have the right to buy. You have a set price. You have a set amount of time. There's no obligation to you. That means you can just basically, if you have that option, you can exercise it, or you can flip it to somebody else, or you can just let it go. That is your right. You have nothing but rights when you buy call options. But here's what you're doing. What are you paying for those rights? You're paying a premium. And that premium could be time only. It could be a mix of time and real value. And so what I thought I'd do is I'd talk about let's create. All right. So let's create a call option in USO looking at today's risk, today's reward, today's break even. All right. Now, to do that, I'm going to pop on over here to the Hub website. And here's the price of USO, a recent price of USO. So if I bring up options on this, and all I'm doing is I'm coming down here and I'm clicking on the options tab. Let me blow this up so we can all see this. Clicking on the options tab, that's going to open up the options. Now I want to look at the options that are in July. Okay, those options that expire in July. Why am I interested in the July options? Because if I'm looking at this as a 5-month pattern, I need to be looking at the options that are expiring between now and July. And over here, I can see everything from volume and open interest. I can look at things like an options delta. I also have the bid and the ask. These are the calls. Puts are on the other side. I'm interested in just looking at the calls right now. So if I were looking at an at the money option, and this is going to change moment by moment, but this is education for you. An at the money option right now on an option that expires in July. Well, right now it's 1780 by 1890. You might say, well, Tom, that's a pretty big bid ask. And I might agree with you, but we're talking about something that expires in July, not today, not next week, not next month. So, if you're going to buy 5 months of premium or 4 months of premium, then you're going to pay for 4 months of premium, especially on an asset that's moving like it is today. So let's say I were going to buy that 108 call option. All right. So I'm going to go ahead and just click on it. And it's going to pop up here right in front of me. And I can see right away that this is going to cost me somewhere around $1,835 to purchase this call option. Now, what does that mean? That means that, what's my cost? Well, it's $1,835 per call. Now, again, what's a call option good for? 100 shares of stock. What's my risk? My risk is $1,835. If the price of oil were to fall or to stay right where it is, that call option would dry up in value because we're paying for nothing but premium. What is my break even? Well, my break even is you take the strike price, You take the premium, you add those two together, and you get your break even, which as of right now is something a little bit shy of $126 a share. What's this look like on a risk graph? Well, I'm going to bring up the risk curve here right now, and you'll be able to see what the risk curve actually looks like on this. Notice that this is my risk. Even at the 108 and change, if we stay at 108, I lose that entire amount that I have at risk. The reward comes in, and this is today. If the price of USO moves up, then those options are going to get the bids and offers are going to bid up. But over time, we've got a hurdle we have to climb. Now, the next question I want to ask myself is, well, where does it got to go? If it's got to go to 125 to break even, where's it got to go in order for me to double my money? Well, if you take $18.35, you multiply that times 2. All right, so what's 18 and 18? 36. Let's just take 36 as a round number. So you take 36 and you add that to the strike price. So if you take a look at 108, which is your strike, you got to add 36 points to that, and that gives you the theoretical double, which is a long way away from where we are right now. So it's cheaper than buying 100 shares of USO. It might be less risky than buying 100 shares of USO, especially if USO plummets. But it's not cheap by options terminology because everybody's into it. The jig is up. The news is up on USO. So what's the next thing I could do? Well, the next thing I could do is I could simply go out and look at call spreading. Now, call spreading allows me to buy a lower strike call, sell a higher strike call simultaneously. All right. And so that allows me to do any trade for lower cost and lower risk. So let's create a call spread on USO, all right, going forward 4 months based on our ideas of where we expect this to go for cost, risk, and reward. So to do that, we're going to go back to our screen once again. And I'm like I said before, I'm looking at USO. I'm looking at the price of USO. I'm looking at the call options over here on the left-hand side, and I'm looking for those July call options. So here's my July options. All right, my July options are popping in. I only see a couple of strikes here, so I want to increase the number of strikes I'm looking at on these calls. Now, in this case, I want to do a call spread. So I can immediately come over here and I can select the strategy and I can select the call spread strategy. So I'm going to do that by clicking on this button and going to vertical, because a call spread is a vertical strategy. When I do that and I come down, I can see some ideas for call spread strategies. And we're talking about something where we're buying a lower strike and selling a higher strike. A 125, 130 would be a lower strike, higher strike. But what if I wanted to buy something that was closer to where the money is right now? What if I wanted to potentially buy something that's farther out there? Well, first of all, I got to look and say to myself, well, I don't want March. I want July. So I'm going to look at the July options. And as I look at July 17 options, I see the 110s, and then I see something like the 111s. Now, remember, we were looking at the 108s. So let's stick with the 108 theme here for a moment. So I'm going to look at buying the 108s, all right? And I'm going to remove the ones that are in play. So I'm going to get rid of those because it just gives you ideas right off the bat. But I want to look at these and I want to judge this where, what we see happening. So what we see happening is if I bought the 108 call, but instead of just buying the 108 call, maybe I sell something against it. Maybe I go out here and I sell the 9, 10, 11, 12, 13. So I sell the 13 call. That's 5 points higher. Right? So if I sell that 113 call, now I bought a lower strike call. I sold a higher strike call. What's the cost? What's the risk? What's the reward? Well, let's take a look at it over here. So here's my cost. Here's my trade. Buying the 108s for July, selling the 113s for July. Not going to cost me $18.35. When I put them together, it's only $147 if I were to get mid prices. Now, what have we done, folks? We have taken a trade, all right? We've taken a trade on USO, which is $108 a share. And instead of paying $18.35 for the call or $1,835 for that contract, we're now able to finance the contract with a higher strike call. Now we're only paying $147. $147. That's less than the cost of a nice dinner out for two. Perfect. What have we done? We've lowered our cost. We've lowered our risk. But we've also we've capped our reward, because the most we can make on this trade is the difference between strikes, and that's 5 minus 147. So we're looking at what? $353 is your potential return on investment. Still not bad when you look at the ROI. This is what the risk graph looks like on this trade. If you were to look at it above, I see my maximum risk. That's over on the left-hand side. I see my maximum reward on the right-hand side, and I see everything else that's going on as far as this trade right away. If I squeeze this in, it's going to show you we don't have to go that much higher by July to hit max reward. In fact, the break even on this one is $109.25 versus what, $126 we were looking at on the call option before, right? And then finally, let's go ahead and look at the last one. And that is, what if we were to do a butterfly on this trade? What if we were to take this trade right here, which is, again, taking a look at what? Taking a look at USO and then building a butterfly. So first, what is a butterfly? Well, butterfly is where we take 3 different strikes. We're going to buy the lower strike, all right, that long call, buy 1 lower strike long call, and sell 2 of a higher strike call. And then we're going to buy an even higher strike call. So there's going to be 3 different strike prices. Buy 1, sell 2, buy 1. What you're doing is you're creating a limited risk trade. All right, this is a limited risk trade. It also is much, much cheaper in cost. So limited risk trade, much lower cost, but you're also creating a reward that is more of a pinpointed reward. Let me discuss that in a moment. Let's go ahead and put this thing together. So it's going to look like this. All right, if I'm looking at a butterfly, I'm clicking on options, all right? And then what I'm doing is I'm going over here to the butterfly portion. I'm going to create a butterfly from these options. So I can go and bring up a number of different strikes, and I'm going to do that right now. I'm going to bring up 24 different strikes on here. I'm looking at the July options. And my July options are telling me, well, here's what it looks like using July. And it's taking the skinniest butterfly known to man, right? Buying the 108, selling 2 of the 109s, and buying a 110. I don't want to do that. What I want to do is I want to create something very similar to what we did just before. So in order to do that, I'm going to delete all the legs except the very first one. I'm going to delete the middle price, the lower strikes. I'm going to delete the one on top, and I'm going to start with the 108 call option. Now, remember what we did with the with what we were selling? We were selling the 113s. So I'm going to sell the 113. I'm going to do it twice. So as you can see here, I've got a number 1 here on the screen. And so what I'm going to need to do is, if I put a minus in there, now it gives me -2. So I'm +1 of the July 108 calls. I'm -2 of the July 113s. All right. Now, here's the interesting thing. I can't go out there and create a 118 because they end at 115. They jump to 120. So in this case, and this is going to happen, right? This is going to happen. This is live trading. And this is what happens to you and I live, is we have an idea what we want to do. And then when we want to put it together, may not work out the exact way we think. So here's what I'm going to do. I'm going to delete my my buy leg. And you know what I'm going to do? I'm going to reset this. So here's what I'm going to do. I'm going to buy the 110s. I'm going to buy the 110 calls. I'm going to sell 2 of the 115s. All right. There's 2. And then I'm going to buy 1 of the 120s. Now, I'll blow this up here for you and show you what this looks like. So here, what we have now on the screen is a butterfly. We're buying a 110 call. That's your lower strike. We're going to sell 2 115s. That helps pay for the lower strike, and it helps pay for a little bit, maybe even a little bit of the upper strike. and we're going to buy a 120. So this is a 5-point butterfly, very similar to the 5-point spread that we had with the bull call spread. So the difference between a bull call and a butterfly: a bull call is open-ended. You get above your sell strike and you're maxing out your profit. You're capping it, but you're maxing out your profit. This is more of pinpointing where you believe that's good profit's going to be. If you believe USO is going to be around the 115 area as we get closer to expiration, then this is the trade you want to do. And the reason why is that when you look at it, now, again, we're not going to be able to get a $2 credit on this trade. Just isn't going to happen between the reward and risk. But can I get this for half the cost of a call spread? Absolutely. Absolutely, you can. So we can go from $1,800 to $200, maybe down to $50 or $100, going from call to call spread to butterfly. So comparing all this, it looks like this. With a call option, if we're buying a call option, cost and risk are going to be the most, but it also has unlimited upside. If oil goes to $200 a barrel, then buying a call is the best choice. If it's cost you're looking for, but you have no projection of where it's going to go other than up, then a call spread makes the most sense because it's cheaper. And yes, it does cap you above the short strike, but it doesn't matter how far up you go. You can max out that reward. And if you're paying, let's say, $150 for something that could be worth $500, well, then you can see the return on investment is quite high. And then finally, and if you like pinpointing things and projecting down to the dollar, then a call butterfly may be the area to go in. It's the cheapest of all three. It's going to have the least risk of all three, but it's also going to have probabilities of profit. They're going to be lower because not only do you need to move higher, but you need to end somewhere in the area where that butterfly's body is. The body I'm talking about is the short strike, because that's where it needs to be when we get to expiration. All right. So questions, comments, etc. Now's the time to put them in here. Nice hat, Tom. Thank you, Liz. This is my Peaky Blinders hat. I actually I have the tweed one, but I couldn't find it this morning, so I thought I'd throw the leather one on and have that on the show today. Yeah. So Constantine, futures on crude oil on slash crude oil was up 28%. That's why we saw that move in USO, because it was based on the futures contracts. So they just bid up the price of USO and it flatlined until USO actually started trading. All right. I see a comment out here. Am I bullish on Bitcoin and crypto? I think Bitcoin and crypto, and those of you that are part of our cryptos and commodities group, we've talked about this, that we're looking for that rotation to come out of gold, out of hard commodities and go into digital commodities. I don't see that happening tomorrow, but I do see a rotation that if seasonality proves itself to be right, then I do see that rotation happening sometime here. I think in the next 30 days, you're going to start to see that rotation. What's the number that I need to see before we really start to get an idea? And we saw crypto make some big moves last week, but a close above 75,000, that would start to return more of that higher high, higher low scenario that I'm looking for. And I'm also looking for crypto winter, at least on the Bitcoin side, to be shorter than it has been in prior months. Because remember, the herd thinks we're going to be in crypto winter for quite some time. If you know me, I don't like to trade with the herd. All right. And in terms of USO and oil stocks as a whole, what I talked about on my comparison is what would I do if I were buying oil today? But, if you know us, we bought oil a month ago, almost a little bit less than a month ago. So guess what we're doing now? We're taking some profits. That's what we're talking about. Okay. We're taking profits right now. And again, when it comes to looking at the call or the spread or the butterfly, you're going to see the butterfly. If you look at time premium, the butterfly is not going to nudge much at all. The big nudging, Oakley, is going to come in July. That's when you start to see gamma come in on a delta neutral spread like a butterfly. So when you buy a butterfly, it's not about today, and it's not even about the middle of the expiration timeline. It's about your observation of where it's going to be at a specified date or a specified month for that matter. All right. So there's you go. There's my show. And as I run out of here for the day, I want to thank you guys for all attending. Again, check out this area up here if you're interested in following me on a regular basis with details on my favorite stocks seasonally that I pick and my research that comes out on a weekly basis. We do this on a weekly basis, and you can now have access to it as well for less than $1 a week. Thank you all for joining. Have a great rest of your day. We'll see you again next week. Bye now.